All right, let's jump right into this explainer. If you've ever found yourself with a little extra cash and thought, okay, how do I actually make this grow? Well, you are definitely not alone. It's so easy to get totally paralyzed by all the financial jargon and the sheer number of options out there. But today, we're going to break down exactly why hoarding cash is genuinely dangerous for your future, and more importantly, how you can systematically build real wealth. And honestly, the biggest secret here isn't about perfectly timing the stock market. It's a lot simpler than that. It's all about adopting the mindset that you should just keep buying. We're going to navigate this journey together by covering 5 main areas today. We'll start with the hidden wealth killer destroying your savings, move into the absolute magic of compounding, talk about the index fund advantage, dive deep into exactly why you need to just keep buying, and finally break down a strategy called dollar cost averaging. Let's get into it. First up, we need to talk about the hidden wealth killer. The big reason we actually have to invest in the first place comes down to a pretty harsh economic reality. You see, the Federal Reserve purposely targets an inflation rate of 2 to 3% every single year to keep the economy moving. So that cash sitting safely in your normal checking account, it's not actually safe at all. It is predictably, constantly bleeding its value. Let's put a concrete, everyday number to this abstract idea of inflation. Think about the number 1,700. That is the exact number of Chipotle burritos you have lost to inflation since 2019 if you simply held on to $50,000 in cash. Yeah, you heard that right. 6 years ago, a burrito was maybe $8 and change. Today, you're looking at closer to 12. It's kind of a funny example, but it illustrates a really stark reality. In 2019, your 50 grand bought your almost 5,900 burritos. Today, that exact same stock of money only buys you about 4,160. That's the insidious nature of inflation. Your money literally affords you less and less over time. It's a pressing mathematical problem, and the only way out of this trap is to invest, so your money actually grows faster than inflation eats it. Which brings us to our best defense, the power of compounding. To outpace inflation, we turn to the stock market, which historically returns roughly 8 to 10% a year over the long haul. But the real heavy lifting here is done by the beautiful concept of compounding. You know that old saying, it takes money to make money? Well, this mechanism is exactly what they mean. Think about the sheer leverage here. Say you've got $1,000 invested and you make a 10% return. You get $100. Hey, that's nice, but it's not exactly life-changing, right? But what if you just leave it there? The next year you're earning 10% on $1,100. Now fast forward. Imagine you have $1 million invested, getting that exact same 10% return. Suddenly, you're making $100,000 a year for doing absolutely nothing extra. The returns just stack on top of each other year after year, completely proportionally and without an ounce of extra effort on your end. To really bring this home, let's time travel back to 1980. If you had invested a mere $100 into the broader stock market back then, today it would be worth over $17,000. But here is the real kicker. Even after we adjust for that burrito-stealing inflation we just talked about, your true, real-world buying power would still be $393 today. Your money didn't just survive inflation. Its actual, tangible value multiplied by 44 times. Okay, so we know we need to invest to get these returns. But what exactly do we buy? We know we want to buy into companies because they're accessible and highly liquid, meaning you can easily cash out. But we absolutely want to avoid the massive risk of trying to pick one single winning stock that might crash and just never recover. Enter your new best friend in the investing world, the index fund, or its very close cousin, the ETF. Forget paying high fees to some professional manager at a mutual fund who's actively trying and usually failing to guess the next hot stock. An index fund is a low-cost investment that simply and automatically tracks a whole basket of companies. It gives you almost guaranteed instant diversification. Think of it like a giant combo pack. If you buy a single ETF tacking the S&P 500, like the incredibly popular one with the ticker symbol VOO, for instance, your money is instantly split up. With one click, you automatically own a tiny slice of Apple, Microsoft, Nvidia, Tesla, Meta, and roughly 495 other top US companies all at once. If one company has a terrible year, the hundreds of others are right there to balance it out. Now we get to the absolute heart of this entire explainer. You know what to buy, but when should you buy? This directly addresses the biggest psychological barrier for beginners, the terrifying fear of buying into the market when prices just feel way too high. It's a totally natural reaction. You see the stock market hitting record numbers on the news and think, is it too late? Should I just wait for a crash? It feels really weird to pay a price that literally no one in history has ever paid before. But get this fact. The S&P 500 actually spends about 8.3% of all its trading days sitting at all-time highs. Record highs are completely normal, and historically speaking, new all-time highs are usually followed by even more all-time highs. But let's say you try to outsmart it anyway. You sit on the sidelines holding cash, waiting for the perfect time to jump in. The cost of doing that is staggering. Over a 30-year period, if you miss just the 10 best trading days because you were waiting it out, you wipe out 54% of your total gains. Miss the 30 best days, your gains drop by a whopping 83%. You literally cannot afford to sit on cash waiting for the perfect moment. There's a brilliant financial writer named Nick Maggioli who summed this up perfectly. He writes, "Rather than worry about whether now is the right time to buy, just keep buying. Market high or market low, just keep buying." This isn't just some catchy slogan. It is absolutely the core mandate you have to embrace to successfully and aggressively build wealth over your lifetime. Now, you might be thinking, but what if stocks actually are wildly overpriced right now? Like, what if the price-to-earnings ratios are just screaming that there's a bubble? Well, Maggioli points out that yes, if you buy an overvalued stock, your short-term returns might be rough or even negative. But the historical data shows something absolutely incredible. If you zoom out and hold those investments for 20 to 30 years, those negative real returns completely vanish. The data converges. Time in the market genuinely cures the risk of buying at a high valuation. Let me give you a prime historical example. Take the year 2012. People were terrified. If you look back at articles from that time, investors thought the market was wildly overvalued, up to 50% overpriced when the S&P was at 1,400. Many people got scared, sold everything, and just waited. But the folks who ignored the noise, stayed invested, and chose to just keep buying, they've watched their wealth multiply by nearly 4.5 times since that huge panic. So how do we actually turn this just keep buying philosophy into a real emotion-free strategy you can start using right now? That brings us to our final strategy, dollar cost averaging. Basically, you have two choices. You could take all your money and dump it in at once, a lump sum, or you can use dollar cost averaging, which means investing a fixed amount at regular set intervals. While both are mathematically valid, dollar cost averaging is a total secret weapon for beginners. By investing, say, $500 every single month, no matter what the news says, you completely remove human emotion from the equation. Psychologically, it's brilliant. When prices are sky high, your $500 naturally buys fewer shares. But when the market crashes and everything is on sale, that same $500 automatically scoops up a ton of shares. It forces you to buy consistently. All right, so here is your 4-step game plan. Number 1, understand your why and your time horizon. Are you young and able to take risks, or are you inching closer to retirement? Number 2, open up an online brokerage or retirement account at a place like Robinhood, Fidelity, or Schwab. Number 3, pick a broad index fund, set up an automated recurring investment, and firmly commit to just keep buying. And number 4, keep educating yourself. The more you learn, the less scary the market becomes. To wrap this up, I really want you to remember that your two absolute biggest advantages in investing are time and consistency. The math of compounding is undeniable, and the cost of sitting on the sidelines is simply too devastating to ignore. So ask yourself right now, are you ready to stop losing your hard-earned money to inflation? What will your future self wish you started buying today? Dive in, automate your strategy, and above all else, just keep buying.